Welcome everyone, my name is Jason Weaver. I'm the managing partner with Weaver Consulting Group, a local registered investment advisor practice in Huntington Beach, California. Thank you for joining us for 3 and 3. Today we're going to be talking about earnings season. This is where public companies announce how well they did for the previous quarter. It's 2 weeks after the quarter ends and lasts for about a month. We're generally going to see heightened volatility during earnings season, as certain companies may miss expectations and others may exceed expectations. What we're looking for is that guidance as we look into 2019. It's going to be very important. So as in 2018, for the first 4 quarters, we had very good earnings growth, exceeding 8%. It's 2019 where we're seeing slowing earnings growth in the first 3 quarters, about 2 to 3%. It's that 4th quarter we're expecting earnings to exceed 8%. Credit spreads. So credit spreads is the difference between a junk bond and a treasury bond. So as those spreads widen, there's some perceived risk in the stock market. As you look into 2001 history, you'll see that credit spreads widened right into the recession. And the same thing happened in 2008. Right now, credit spreads are pretty tame. This is the difference between credit spreads and the S&P 500. So as we generally see credit spreads widen, the S&P 500 will get more volatile and usually is in a down pattern. Last year in September, we told you that credit spreads were a little too tight and we expected them to widen. And boy did they widen all the way up until December. And the stock market followed suit. We're giving you that warning again today. And you should pay attention to your junk bonds or low quality bonds because credit spreads from our perception are too tight right now. So yield curve. The yield curve is a proxy for investors because what we're looking at is a steep curve or a flat curve. A steep curve generally tells us that the future looks bright. So short-term interest rates should always pay less than long-term rates. But if that curve starts to flatten out or even invert, then potentially something's going to happen that might be detrimental to the economy as we look into the future. So this is going back all the way to 1982. And anytime you see an inversion, usually a recession follows. So since 1955, 9 out of 9 recessions have been preceded by an inverted yield curve. So this is why this is a very important indicator. As we look into 2019, we did have an inversion of the 3-month and 10-year Treasury bond. Some people use that as an indicator, and some people use the 2-year bond and the 10-year bond as an indicator, which has not inverted yet. So we'll see what happens as we go forward. Thank you again for joining us for 3 and 3.